As you can tell with this one, I'm pretty busy, and yesterday's video was supposed to be about 45 minutes long. Seriously, I recorded for ages. So I decided that was too long and I'm going to split it in two. So today's video is a little bit disjointed because it contains a lot of the video that was supposed to be in yesterday's video. So today is going to be all about Elliot Management and GlaxoSmithKline, and then I'm going to do a full breakdown of my portfolio right at the end. Hope you enjoy it. Sorry it's a bit disjointed. Sorry, it's been so long this weekend.
Can I get down?
Yeah, okay.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
I also want to talk about Paul Singer. You may have heard of him before. He's the head of Elliot Management, and loads of you today have been asking me about GSK. So I'm going to quickly dive into what GSK is about to do, considering it's had quite a big push today, all on the news that Elliot Management have decided to get involved. And I'll discuss whether that could be a good or bad thing going forward with Elliot Management getting on board of GSK. And then finally, what I want to do is I want to take you through, I promised last week, I want to take you through my portfolio. I'm going to do a very quick, Peter Lynch described to an 80-year-old elevator pitch style on all of my stocks to make sure I know what's going on with these stocks right now. I'm going to do that all off the cuff as much as I can. And if I can't tell you what these companies do in 10 seconds or so and tell you why they're meaningful for the future, then I really need to start thinking about whether I should be owning them or not. So I'll take you through all that, and I will finish on Bitcoin as well, because Bitcoin and Ethereum are going absolutely mental at the moment. So I'll take you through that at the end as well. So we've got a long ass show today. I can tell you towards the end of this, I'm going to be really tired and my throat is going to be so sore, but let's get to it. Okay, some very current news with this new Bond villain called Paul Singer. In case you didn't know Paul Singer, he's the head of a company called Elliot Management, and he's one of the most feared guys in the investment world. I would say feared because every time he comes into a company or invests in a company, he tries to change it. He's what's called an active investor. So Singer finds companies where he thinks the business could be run better. He goes in and he invests in these companies with quite considerable amounts, like very, very large amounts. So if he were to leave that company, if he were to sell out of all his shares in that company, it would have quite a detrimental effect on their share price. And he does this with lots of different companies. He usually goes in, buys quite a considerable amount, writes them a letter saying, I think you should change this, and change this. And if the company does it, then fair play. He starts to gain some money. But if the company doesn't do it, he sells out and then he leaves them in the basically. He's been trying to do this recently with Twitter. He's been trying to replace Jack Dorsey as CEO. And to be fair, that's not a bad idea. Jack Dorsey is a terrible CEO of Twitter right now. He just doesn't care. He's all busy on Square. So that's not a bad idea. He's also been in AT&T and he had little effect on AT&T. He said that he was putting in $3.2 billion and said that the stock was going to be $60. And to be fair, I don't see that as an unrealistic opportunity. But since then, they have sold out because AT&T largely put the middle finger up at him. They did fire a lot of people on Paul Singer's advice, but apparently that might not have been good enough. And Elliot Management did pull out of AT&T probably last year sometime, and then came back in with a very small amount as well. So this is what Paul Singer does. He comes in, he buys big into these companies, puts them at very high risk and kind of holds them to ransom to get them to do what he wants them to do. And then if he doesn't like the outcome, he just sells out. And recently this week, Paul Singer has bought into GlaxoSmithKline. And this has been a huge, huge topic over the past few days on the Discord and in the comments of my YouTube. We all want to know what's going on with GlaxoSmithKline because whenever Elliot Management touches a company, this is what the share price does. But like I said, Elliot Management getting into a company isn't always good news. Paul Singer is absolutely ruthless. He will go in, destroy your company to try and make it the way that he wants it to. And if it doesn't work out, he just off. But he has made a lot of money doing this, and he is often right. I'm not sure what Elliot Management sees in GlaxoSmithKline right now. GSK is a very flat stock. It basically hasn't earned anything over the past kind of 20 years. Its 10-year and 5-year revenue growth is absolutely flat. So there isn't a lot going here on GSK right now. And to be honest with you, I did used to own this stock mainly for the dividend, but I got out quite a long time ago when I realized there wasn't really anything new coming from this company. There wasn't a lot in the pipeline, and there wasn't anything, it just wasn't growing. And if you'd held this stock for 20 years, you'd be up 1.8%, mainly because of that 5% dividend that they've always got. But you would have lost 31% in capital. Buying the dips and trading GlaxoSmithKline is actually quite profitable though, if you can do it right. And this might be what Elliot management is seeing at the moment. They're seeing that GlaxoSmithKline is actually undervalued. It is below its intrinsic value, so maybe there might be something there. And all Paul Singer really needs to do is step in, make some noise, make some changes, and in the next, say, 3 years, he could be looking at a 27% growth. However, GlaxoSmithKline is just one company that I do not want to be investing in right now. There's plenty of time to figure out if this company is going to turn it around with its dividend cuts, with its spin-offs, everything like that that's going on. Just not one that I'm going near. I think there are far better opportunities out there for me, not as Paul Singer. Paul Singer's probably got something in mind. Expect a letter to GlaxoSmithKline to come out in the next couple of weeks saying that they should cut this, cut that, spin off this, and pay down some debt or something. I don't know. But expect an open letter from Elliot management in the next couple of weeks, maybe even days, maybe even the weekend. Okay, I've got 2 things I want to finish off with. I want to finish off with my portfolio and very quickly go through all 28 investments that I've got in my portfolio right now. And I want to talk a little bit about cryptocurrency right at the end. So if that's interesting to you, thank you for sticking around. This is going to be an absolutely massive video once again. Okay, so my portfolio is sitting at 25,115. Markets closed today on the, I don't even know what date it is, the 15th of April. This is largely a dividend reinvestment, dividend growth portfolio, and all these companies that I'm buying in here are bought at a significantly lower value than I think these companies are worth. I can safely say that all, or at least most, are bought under their intrinsic value as I calculate it. My minimum goal is safety and to beat inflation, and I think I can safely do that. However, while I do think that I have a very low chance of losing money by buying these companies, I do also think that some of these companies will outperform the market. For most people who just want to make money for relatively low risk, you are best buying an index fund. You won't have to put all the work into learning about all these companies that I do. However, you won't have a chance of beating the market because you're in the market. So my portfolio is based around low risk, but hopefully low valuation, and it gives me the chance of beating the market while also not having a very high chance of losing money, if that makes sense. And I have to reiterate right here that being in a low-cost, well-diversified index portfolio is probably the best thing for the majority of people out there. Just set, forget, cost average. Very, very simple. That should make you money with quite a low risk, but obviously returns aren't guaranteed. And today I wanted to very quickly, or at least as quickly as I can, take you through sort of 10-second elevator pitch styles of all my stocks. And I'll start with 3M. 3M is an industrials company with a ton of patents. This thing has a massive moat, and it's all down to its IP. 21.85% up on the year. Wish I'd bought more. AT&T is one of the leading telecommunications companies in America. It runs your mobile phones, but also has this little wing into streaming with HBO Max. Down 4.55% on the year, mostly in FX. Yep, I think this company is going to do very well this year. I'm buying more, even over $30 right now. Avalon Bay Communities is a high quality apartment REIT. You saw my stuff in the guide to the markets that I said earlier. Apartment REITs are really hot right now, and I think this company is going to do very well going into the future. It's set up the working from home space. It's building communities with a view from working at home, and this company is up 17.74%. Wish I bought more again. Oh my God. Dividend yield of 3.42%. So this company is going forward probably going to do me pretty well. Bae Simpsons is a British defense company that I believe has a lot of cash on hand and is very safe at the moment. Also recently had a huge government contract in defense spending from the UK. This company is going to do very well over the next few years, in my opinion. It's up to you. British dividend payer, dividends 4.64% right now, 8.4% up on BAE Systems. BAE Systems is a bit of a rough ride though. It's a British company, so it doesn't grow very fast. What you got to do is you just got to wait till it dips down to your sort of target price and then just keep buying. And I feel like BAE Systems should do really nicely in the long term. As a safe bet, it's not likely to be one of those ones which outperforms the S&P 500. Bristol Myers Squibb, I've done a load on recently. A pharmaceutical company with quite a considerable pipeline in comparison to its market cap. As far as I can tell, only Pfizer has a much bigger pipeline than Bristol Myers Squibb. Pfizer is also one company which I've been looking at recently. It looks very attractive to me. It's undervalued right now, Pfizer is. I'm talking about Pfizer instead of Bristol Myers Squibb. But Pfizer actually has 94 drugs going through its pipeline right now in comparison to Bristol Myers Squibb's 50. Those are two ridiculously high numbers as far as pipeline goes, but also Bristol Myers Squibb is considerably undervalued in comparison to Pfizer right now. Broadcom, we talked about semiconductors recently. Broadcom is the backbone of every single mobile phone out there, basically. It makes all the little tiny parts that go in to make up your cell phone, and eventually will make up all the little tiny parts that will go into your EV as well. Broadcom, I think, is one going forward for the future. I think it's going to be added to the FANGs eventually. This company has been on a tear. I bought in so late. I tried to buy in this little dip right here. I bought so late into Broadcom. I wish I bought it down here when I was first looking at it with ASML and KLA, which we'll talk about later. Digital Realty Trust is another industrial REIT. This is a REIT for data centers. It's very heavy in Europe, the UK. It's recently done a deal to sell some of its data centers in the UK. Data centers are essentially going to be a backbone of all business going forward. This is why I'm in Digital Realty, but I do think that I've bought Digital Realty at quite a high valuation. I think I might have made a bit of a boo-boo there, and you can see that the share price is making me pay for it. 1.25% down on the year, mainly due to effects, but if I bought this company a little bit earlier, I would have seen quite a considerable rise in capital appreciation as well, and that's a bit disappointing. Johnson & Johnson is just one of those companies which is going to be in my portfolio forever. It's a high quality pharmaceutical and consumer goods company that constantly makes money and actually has quite a good growth rate of 6%. Recently going through a bit of a tough time with the vaccines causing clots and things like that, but that really should not affect Johnson & Johnson's underlying fundamentals. Looking at the share price growth, this company compounds like a bastard. So this is a reason to own Johnson & Johnson. Probably won't outpace the market, maybe fall 1 to 2% below the market, and will act kind of like a bit of a bond for you. JP Morgan is the best of the banking stocks, in my opinion, has the most cash, has the most safety of any banking stock that's out there, and really does have its finger on the pulse. Jamie Dimon is a bit of a loudmouth. He does really say the things that he wants to say. He's been wrong on Bitcoin before. He's probably right on the economy right now, but he does have this fear of new fintech. He does see the boundaries of fintech coming. He's trying to push for fintech to have more regulation. Companies like PayPal and Square are essentially acting like banks right now, but they are completely unregulated. There is going to be a change there, and Jamie Dimon and JP Morgan Chase are probably going to push that forward. And in the meantime, JP Morgan are heading towards the Square and PayPal model by having contactless payments and payment systems for businesses. This company does see what the future of fintech looks like and is slowly merging and taking up a bit of that market share right now. If you want to build a semiconductor fab lab anywhere in the world with TSMC or Intel, you need two companies. You need a company called ASML to build the things, and you need a company called KLA to do the quality control. KLA is a meteorology company. You don't need to know that. because semiconductors and microchips need to be tip top before they go out. They need to be perfectly built. KLA provides the machines to do this, and this thing has such a wide moat. I think it has 80% of the market. KLA is one of my favorite stocks. I don't know why I didn't buy more. Legal & General Group is a huge insurance and investment company here in the UK. Massive dividend, loads and loads of cash, loads of investments going forward. Their investment style isn't as aggressive as, say, some of the bigger ones like SMT or ARK Invest, but this company does have a lot going for it, a ton of cash. It basically owns everyone's pension. And even now, under 300 pence, I do think that this company is still undervalued, and I'm actually still buying a bit more right now. Lennar Corp, and I have LenB for some reason. I don't know why. I just decided to choose the cheaper one. I don't know why I bought the Class B shares, but Lennar is the second biggest house builder in the US, and the US doesn't have enough houses right now. That's simple economics to me. There's not enough houses in the US. More houses need to be built. Supply, demand. Lennar is going to go up, has a lot of cash on hand. This company is undervalued, and I believe that this company will be S&P 500 beating going forward. Medtronic is a medical supplies and medical machinery company. Does a lot to do with diabetes. And basically in the UK, if you've ever had a stent from a heart attack, you've probably got a Medtronic product sitting inside you right now. Medtronic products are vital for the future. They are always improving these products. There is a mini moat going on there, at least in their own personal part of the medical world. They don't have a lot of competition. And obviously Medtronic's fundamentals, for me, are pretty top class. Merck & Co. Keytruda. That's all I can really say to you is Keytruda on Merck. One of those companies I'm probably going to start thinking about in more detail. Try to really learn about the company a little bit better. I'm not sure yet. That'd be my first one where I go, maybe I haven't got a brilliant conviction on Merck right now. Microsoft. What do we need to say about Microsoft? You've heard of it, right? Do I need to go any further than that? Just a massive software company and also a military hardware company at the moment. Microsoft is a company that is constantly growing. I think it's got a profit margin of like 30%, something like that. Yeah, profit margin of 30.96%. This company is a powerhouse. It is making loads of money. It's going to be so relevant in the future. Microsoft isn't going anywhere. Pepsico also isn't going anywhere, but it isn't making enough money right now. Pepsico is one that I'm not completely sure of anymore. A great dividend payer. I think it's got a dividend of like 3%. Yeah, 2.86%. But its revenues and its income are not going in the direction that I want it to go. I may see what 2022 has for PepsiCo, but at the moment it's for the better of those consumer staples. So I'm staying with it, but we'll see. I don't know. Raytheon Technologies is an aerospace company that is heavily beaten down right now due to the pandemic. Raytheon Technologies is pretty much my only reopening play. It has a 70% of their business in aerospace, particularly in the maintenance of aircraft. So once aircraft start flying again, we will start to see Raytheon Technologies businesses start to pick up a little bit as the maintenance of the aircraft goes on. It's also got 30% in military, where it just blows the crap out of stuff. I believe that Raytheon Technologies is made up of Raytheon and United Technologies, which are two 90 billion companies in value on their own. So this company should easily have a market cap of 180 billion, but it doesn't. Currently its market cap is 118 billion. I think this company is worth a lot more, and I will see this company's share price go back up to $151 within probably 5 years. That's what I expect. Realty Income is a long-standing REIT. It's sort of the king of REITs. It's the monthly dividend company. Pays a dividend of 4.32%. Realty Income is a triple net lease REIT, which means it rents out all of its buildings to its customers who pay for everything. Realty Income basically gets the rental income from the property, and the company that is living in the property at the time pays for all the maintenance and the capital expenditure. That is an excellent way to run a business, in my opinion. There are risks to this because it is quite heavily in the retail sector, but this company I'm willing to sit on. It has a very good track record and a very good history of growth. Rio Tinto is a cyclical mining company which is doing very well off iron ore, copper and lithium right now. However, this party may end soon. I have currently stopped buying it after my last buy. I have stopped buying it right now, even though it is technically still undervalued, but I will buy more when it comes down to around £4.90 again. Remember what I said about industrial REITs earlier? Well, Segro and Tritax Big Box are two companies that are catering to the industrial sector. They have a lot of exposure to online retail with Amazon, but they also do have a lot of industrial properties as well, kind of centered around London and Europe. These two companies are doing exceptionally well right now. Again, wish I'd bought more. Store Capital is another triple net lease doing very well, 26.26% up. This company rents out its properties to smaller businesses that might not be affected by the online retail space. Businesses such as gyms, corner shops, furniture centers, things like that might do very well in a climate where the world is being taken over by online retail. Doing very well, like I said, 26.26% up. Very happy with that. Tyson Foods is basically where you get your foods from. Even here in the UK, you are likely eating some form of Tyson Foods protein. If you go to McDonald's in the US, you are very likely to be eating a chicken that has been grown in a Tyson Foods farm. There's lots of little ethical issues that you need to think about here, but it's very simple. The US, China, and other emerging markets all need to get some protein from somewhere, and at the moment Tyson Foods is providing pretty much all of it. Unilever. Now, I want you to go out to your local supermarket and pick up pretty much any product and have a look on the back. If there's a little U that's in the shape of their logo, Unilever own that product and they probably produced it. Unilever is a massive consumer staples company. It does have its risks. It is divesting a lot to try and keep up with its dividend. And it is also at risk to generics right now as people start to want to pay less for some of these products. So there are a couple of risks to Unilever. It is one I'm still constantly trying to review and see if I should be in this stock right now. But Unilever is generally going to be one of those safer stocks that stays around. It's from that old traditional dividend mindset that I used to have. It might stay in my portfolio. I'm not sure yet. Vanguard Emerging Markets. Do I really need to explain this one right now? Because I just did a whole video on it. But what's very good is this fund has TSMC, Tencent, Alibaba, Meituan, Naspers, I don't know Reliance, I don't know China Construction very well, but JD, Ping, and Infosys. These are all big companies at the top of their distribution. This is basically my exposure to the emerging markets because China is very hard to value at the moment. It's also very hard to put Chinese stocks into an ISA. So what I do now is I diversify across lots of different companies, lots of different countries as well by putting it into VFEM. You can also use the iShares Emerging Markets MSCI, which includes South Korea, which is going to be a very good one going forward. I do want to consider putting my money into the iShares BlackRock one as well. We'll see. The only reason I have the Vanguard S&P 500 in my portfolio is to check my progress against it. And right now, because I've put in a lot of money today, these two are pretty close right now. My income pie is up 13% right now, and that does not include dividends, which is very interesting. So I should be more like 15% up, and I'm very closely trailed by the S&P 500 at 12%. The way I track the S&P 500 versus my own income is every time I put in a deposit, I will put 5% of that into the S&P 500, and then the rest goes into my income pie. And that way I feel like I can safely track the S&P 500 against my own income pie. Right now, I'm just a hair ahead of the S&P 500 in unrealized terms. In realized terms, I'm probably closer to 15% above. Visa is the world's largest payment processing company, and it will continue to be. Every time that someone makes a payment on a credit card or an online payment out there, Visa is pretty much the one that's going to be involved to take the money out of your bank and put it into the business account. I've hopefully got a quick stock analysis video coming up in Visa soon, which will go into way more detail about what I'm thinking with Visa. And finally, Walt Disney, which is one of the most recognizable brands in the world ever. Warren Buffett describes it as a wonderful business, and this is generally a reopening play. The parks are going to open very, very soon with Walt Disney, and everyone is going to be there. But also Disney Plus, and Disney Plus is a service that I am also paying for. And if you gave me the choice between Disney Plus and Netflix right now, I would 100% choose Disney Plus. I would get rid of Netflix, honestly. And that mindset that has occurred in my head has made me think that Walt Disney is a far better bet in the streaming world than Netflix is right now. That is my personal opinion. Of course, Netflix is going to be a massive powerhouse going forward. I'm not saying that Netflix is going nowhere. I'm saying that Walt Disney is going to be a very good example of either number one or number two. What's most important about this entire portfolio is to remember that while I'm very scared of a bubble, and I do believe that the S&P 500 right now is at a stupid valuation. I do believe that PE ratios are stupidly overvalued right now. I do believe that some areas of the stock market are in massive, massive bubble territory. I will not be stopping investing. I'm going to continue cost averaging into the markets, but what I'm going to do with that money is not necessarily buy all of these companies at all the same rates at all the same times. I'm just going to put my money into certain companies which I think are undervalued at the moment. So I'm always going to be putting money into the market as a sort of cost averaging, but I will also be finding the best companies, in my opinion, the most undervalued companies to be putting my money into right now. 25,120 is what I've ended up with on the day, and I'm quite happy with that. I'm quite happy with my 13 to 15% return overall. And finally, are cryptocurrencies in a bubble or not? Probably. But I don't think Bitcoin is ready to pop just yet. I haven't touched the charts on Bitcoin for quite a while now, so I'm just going to draw a few in. It looks like we have our prime trend line still going on here, which is something like that. And then we have our top trend line going across here. You see how this touches 3 times here, and that seems to have created an ascending wedge, which is quite a bullish sign in the short term, but bearish in the long term. A lot to explain on that one. Inside, we'll have a quick look at some resistance. There's a strong resistance going across there. That's very important. But we're looking, because it's in such a bull run right now, I'm looking at diagonal trend lines. And what I can see is, I can see one right about here. Just there. That looks pretty good. So downside risk on Bitcoin right now is quite a lot. If we see price action go below this line, bounce through to this line, and then break this line, we're going to see Bitcoin at about 45,000. But really, Bitcoin is in a massive bullish trend right here. You can see we've got the shoot up, we've got bull flag, shoot up, bull flag, shoot up. And we're constantly running this cycle over and over again, which shows that Bitcoin is certainly in a bull market still right now and is showing no real signs of slowing. To me, what's more important is Ethereum, and Ethereum is definitely gaining more traction than Bitcoin right now, much more than I expected. And that's because I think the knowledge of Ethereum is becoming far, far more open right now. I personally believe in Ethereum a lot more than I do Bitcoin. I think others are starting to understand that with the benefits of smart contracts and with the benefits of different ways that Ethereum can be used going into the future. And you can see how Ethereum's price action is going very, very well right now. It's just about to touch this top resistance line. It's about to break out even further. You might find that it might consolidate a little bit along these 4 lines now until the next big bit of good news comes up. There may even be a strong pullback all the way back down to 2,300. And if it does fall through that 2,300 mark, the next safe spot really is 2,100. That's the next big bit of resistance. So this stock could fall now easily, sort of 30-40%, all before we have a big melt up. And I think that eventually there will be a huge and massive parabolic move that will just shoot right upwards one day. It will happen so quickly, and that will be the time that you need to get out. That will be the time that I will be looking to sell out of all my cryptocurrency and wait for the next 4-year cycle to start again. That's just my personal opinion on Ethereum and Bitcoin. You will probably have something totally different in mind. That's okay, but this is the plan I'm following. This is how I feel. This is how I feel the stupid human behavior and the pent-up demand in an asset that hasn't been fully proven yet. I think that's where this is going. I do fully believe in Ethereum more than I do with Bitcoin, but I know how strongly people feel about cryptocurrencies. So everyone's got their own opinion. Let me know what you think about the cryptocurrencies. You let me know where you think Bitcoin and Ethereum's going on. But please back it up with some real information. Don't just say to the moon or whatever. Please back it up with something that's actually got some substance. All right? Thank you very much for watching, everyone. I'm about 2 hours into recording now, so this is going to be a massive one. Thank you so much for making it this far. Thank you very much for watching, everyone. The investment app that I use is called Trading212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, you can get a free share that's worth up to £100. And I also get a free share as well. I also use eToro to buy my Bitcoin and Ethereum. If you wanted to sign up through that, you really helped out the channel. Just remember that cryptocurrencies and everything are really volatile, and everything that I said could have been just full of shit. Please feel free to continue the conversation by leaving a comment below or joining the completely free Discord, where we have loads and loads of different conversations about different stocks, different cryptocurrencies. It's really, really interesting there. Loads of people have got different ideas, and there's a lot of really good and well thought out conversations in here that really do make you think about different ways of investing. Also, feel free to check me out on Instagram, where I post lots of pictures that I think look like penises. Has anybody else noticed how phallic the Blue Origin rockets look? They really do look like penises. Well, kind of looks like mine anyway. But I also post up little tidbits of information that I find out there on Instagram and out there on different websites, like this one, which shows the activity of all of the meme stock frenzy since January of 2021. Where you all gone, guys? Where you all gone? Check out the purple line of activity of Robinhood. It's really dropped. It's a really good sign that a lot of investors are starting to get a little bit bored of investing. Thank you very much for watching, though, and if you enjoyed this video, please feel free to like, subscribe, and invest. Ooh, little burp in the end there. How did that happen? That's a present for you.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.
Say hello.
Hello.
Say cost average.
No.